Hello, I'm Andrew Winter, host of Selling Houses Australia, and welcome back to part 4 of Compare the Market's Mortgages Made Simples. In the second to last instalment of this series, we will be talking about the fourth C, collateral, which is all about the property you are buying and what your home loan is secured against. We've all got a dream home, but unfortunately you can't just pick any property you'd like to buy and get a home loan for it, even if it's within your budget. That's because home loans are secured loans, meaning there's an asset tied to the loan, which the lender can take legal ownership of in the event that you can't meet your loan repayments. In the case of a home loan, the home in question is the asset, which means that if you can't meet the repayments of your home loan, the bank would be within its rights to repossess your home and sell it to pay off the loan. But the important bit there is the lender being confident that they would be able to sell your home for an adequate price if push came to shove. And that's why lenders can be quite particular about the types of property they secure large sums of their own money against. Some lenders also just flat out refuse to deal with properties in higher density buildings, perceiving them as a riskier bet. And what's extra fun is that the lenders that do cover high density housing will probably charge you a higher interest rate for the privilege. With that in mind, be sure to check your loan options when looking at different property types, as different lenders will have different products and rates available depending on the property you are trying to buy. And while we're here, let's briefly talk about guarantors again. Something a lot of people don't realise is that all these hidden no-nos for picking a lender-friendly property, they apply to guarantor properties as well. What this means is, depending on what kind of property your prospective guarantor lives in, the lender may not view equity in that property as particularly valuable. Subsequently, they may say no to letting that equity form part of your property deposit. So just keep that in mind if you're thinking you might want or need a guarantor in order to get a home loan. If you are already on the property ladder and looking at your next home, you may want to consider how different property types in different locations tend to fare value-wise. For example, an off-the-plan apartment is much less likely to appreciate in value over the years than, say, a Queenslander on acreage. Obviously, that's a huge generalisation, but it's one based in truth. Land is king if you are looking for capital growth, and freestanding homes typically come with more land than apartment or a townhouse will. Conversely though, an off-the-plan apartment in an attractive suburb may be a smarter pick than a freestanding home on land in an undesirable neighbourhood. So future value growth isn't always just about property type. You need to keep additional factors in mind, like location, room count and floor plan. But more important than picking a property that will grow in value is picking a property that won't decrease in value over the long term, because then you do start to get into some fairly dangerous territory. Your LVR can skyrocket. You can even end up with what we call negative equity, which means you own less than 0% of your house and you owe your lender more than the property is actually worth. So while you don't need to be a market genius targeting 10% growth year on year for your property, I do encourage you to take a long, hard look at any properties of interest to you and ask yourself, do I think this property will be worth more or less by the time I sell it? If the answer is less, it might be time to take that property off your shortlist. Another C done and only one more to go. I'll see you next time for part 5 and the final C, conditions.